Hey, this is Chris. Now, as a lot of people know these days, ETFs are a great long-term investment. And if you can avoid a few common traps, you're really going to set yourself up for success. So in this video, I'm going to be talking about 3 mistakes that I see quite often with people who are investing in ETFs. Now, the first mistake I see quite a lot these days, especially because there's a lot of competition between ETFs on fees, is people that just buy ETFs based on the fees alone. There are a lot of similar ETFs out there, and so I guess a simple way to try and discern the difference between them is just to line them all up and buy the one that's the lowest cost. It makes some sort of sense because low cost we know is better, but what we've discovered is there are actually other factors that are just as important as fees, if not more important than fees, over the long run. And so when we look at different ETFs, we consider other factors like the liquidity, the bid-ask spread, things like the track record of the index itself. And once you account for all of these different factors, it may be that small differences of fees don't really make the biggest impact, and you might not want to buy always the cheapest ETF. Certainly we see in our portfolios that in some cases we've bought the second or third cheapest ETF, and it's actually performed a lot better than the cheapest ETF. So don't always look based on price alone. The second mistake I see a lot is people that just buy ETFs based on past returns alone. It's not just an ETF mistake, it's a mistake I think people make across the investment spectrum. Don't be tempted just to buy the things that have done well. Look for things that potentially haven't done well and that aren't popular as well, because these are the things that are likely to revert back and give you good performance in the future. Really, you don't need to take performance in the past into too much of an account altogether. Really, you should just be looking at broad asset classes that have given great long-term performance in your portfolio. The third mistake I see all the time is people that buy a few ETFs that think they're really diversified, but ultimately those ETFs have the same underlying investments. And I call this double up diversification. People who think they're well diversified, but ultimately they all own the same investments 3 times over. A good example would be someone that buys an ASX 300 ETF, as well as an ASX high dividend ETF, as well as an Australian shares ethical ETF. And you may think that you've got 3 different ETFs, so you're well diversified, but all of them will really have the same investments. And so make sure when you're diversifying to own different asset classes, different countries, different sectors, not just the same thing 3 times over. And if you can avoid those 3 mistakes, you're going to set yourself up for great ETF investment performance.